Imagine a way to build wealth that doesn't just, rely on hoping a stock price goes up, but one that also pays you consistently along the way.
Yeah, a strategy really focused on tangible cash flow.
Exactly. And it seems accessible to anyone willing to look beyond just the headlines, understand how successful companies actually share their profits. Our sources suggest that, aligning yourself with businesses that consistently reward shareholders with dividends, that can be a foundational element for building financial comfort, maybe even sustaining you for a lifetime.
And the sources even hint at what some might call the holy grail of investing.
Right, that combination. Current yield plus dividend growth.
What's fascinating here is that this isn't really about speculative bets, is it? It's more about partnering with established, often, quite resilient businesses.
Okay.
So the mission of this deep dive is to take this diverse stack of source material, articles, research notes, historical data, and really extract the most important nuggets of knowledge about dividend investing, particularly focusing on U.S. stocks.
Right. We want to help you understand the core mechanics, explore the key metrics analysts use.
Yeah, look at how market cycles impact these strategies, discuss ways to manage risk, and maybe even touch on navigating portfolio withdrawals, especially for income in retirement.
And we'll be categorizing these income generators into different tiers, what some lists call the champions, contenders, and challengers.
We'll dig into what makes companies fit into each category.
And discuss why each might be attractive or sometimes, maybe a bit riskier for a portfolio.
Okay, so let's unpack this core idea then. Dividend investing. At its most basic, fundamental level, it's about buying and holding shares of companies that pay out a slice of their earnings directly to shareholders.
Typically every quarter, right?
Yeah, usually quarterly.
And you mentioned that holy grail idea, current yield plus dividend growth. Why is that specific combination so, emphasized in our sources?
If we connect this to the bigger picture, current yield, that gives you immediate cash flow. You get income right now. Dividend growth, though, that's crucial because it means that income stream has the potential to actually increase year after year.
So it keeps up.
That's the hope. This rising income stream is absolutely vital for fighting inflation and, maintaining your purchasing power over the long haul. That dual benefit, getting paid today and potentially getting paid more tomorrow, that's what makes this approach pretty powerful for building both wealth and a sustainable income stream.
So you're not just sort of passively waiting for the stock price to go up. You're benefiting in two pretty distinct ways.
Exactly. You get the direct cash payment from the dividend, and you also have the potential for the stock price itself to climb over time. That's your capital gain.
Right.
Unlike owning a stock that doesn't pay dividends, where your whole return really hinges on selling shares higher later.
Yeah, you need that price jump.
Right. A dividend stock offers these two potential avenues for profit at the same time. It's a tangible return you receive regularly, pretty much regardless of what the market's doing day to day.
And receiving those dividends, it feels like a real share in the company's ongoing success, doesn't it? More direct.
It absolutely does. Instead of having to, say, sell off a piece of your ownership whenever you need cash, which can trigger taxes, fees, dividends let you tap into the company's profitability on a usually predictable schedule, say every 3 months, without actually reducing the number of shares you own.
If you don't need that income right away, you can put it back to work.
Precisely. That dividend cash flow can be reinvested, often automatically through what they call DRAPs, dividend reinvestment plans.
Right.
You use it to buy more shares of the same company, or you could direct that cash elsewhere. But that process, reinvesting dividends, it really accelerates the compounding effect. It allows your ownership stake and, crucially, your future dividend payments to grow exponentially over time, even if you're not adding fresh cash.
You mentioned inflation earlier. That's always a concern. How does an investment that pays dividends help with the rising cost of living?
This is really where the dividend growth part of that holy grail becomes so important. Historically, profitable companies committed to dividends, they tend to increase those payouts annually.
It's not just a fixed payment.
No, exactly. It's not static like, say, an old bond coupon. As companies grow, as their profits increase, they can often afford to pass some of that success along by raising the dividend. Over the long term, this increasing income stream has a pretty good track record of keeping pace with and sometimes even beating inflation.
So it protects your buying power.
That's the goal. It offers a crucial layer of protection that many fixed income investments just can't match over decades.
And the sources point out that in periods of really low interest rates, like the environment back in early 2015 they described.
Yeah, when bond yields were tiny.
Dividends became even more attractive as a source of current income.
Absolutely. When you're struggling to find, meaningful income from traditional bonds or savings accounts, dividend stocks step in to provide that cash flow. That yield difference makes them particularly valuable in a low-rate world. It offers income potential you just couldn't easily get elsewhere without taking on maybe a lot more risk.
So the appeal is definitely clear. But like you said, you can't just buy any stock that happens to put dividend. Our sources really hammer this point.
Yeah.
You've got to look past the headline yield.
Yeah, you have to examine the company's underlying health, the sustainability of that payout.
So how do you tell the difference between a genuinely strong dividend payer and one that might be, well, maybe in trouble?
That's the key question, isn't it? Just chasing the highest yield, that can be a major pitfall. It often leads investors straight into what they call value traps.
Value traps?
Yeah, companies paying out an unsustainably high percentage of their earnings just to lure buyers in. But they're likely heading for a dividend cut down the road. You really have to look under the hood.
Right. So what are the absolutely crucial metrics we need to assess according to these sources?
Okay, first, there's the simple dividend itself, or the dividend rate. That's the total annual income you get per share.
Okay.
Our sources highlight that fundamentally this income should come from the company's profits. While, sure, a company can dip into cash reserves short term.
That won't last.
Exactly. Long-term sustainability absolutely requires consistent profitability. And what's fascinating here, and sometimes gets overlooked, is just how significant dividends have been historically in total market returns.
How significant?
The sources note dividends have accounted for a massive chunk, over 40% of the total return of the stock market over long periods. That's huge.
Oh, more than 40% of total return just from the dividend payment. That really does underscore the power here.
Okay.
So beyond the dividend amount itself, what's the next key metric?
That would likely be earnings per share, or EPS. You calculate this by taking the company's total profit and dividing it by the number of shares outstanding. It's widely seen as a primary driver of a stock's price and its underlying value. The sources give a simple example. $4 million in profit, 2 million shares, that's $2 EPS. It's basically how much profit each share represents.
And EPS directly leads into the price-to-earnings ratio, or PE, right?
Yes, that's simply the current stock price divided by the EPS. It tells you how much investors are willing to pay for each dollar of a company's earnings. Generally speaking, a lower PE ratio is seen as a sign of better value. You're paying less relative to the profit.
But our sources make a pretty compelling case for another metric that some analysts maybe even prefer over traditional EPS.
Yes.
Cash flow per share.
This is where we get maybe a deeper look into the company's financial plumbing, you could say. Cash flow per share is usually calculated as operating cash flow minus any preferred dividends, then divided by the number of common shares. It's the actual cash generated by the core business operations available after necessary spending and obligations.
And why do some analysts, like Value Line mentioned in the sources, often prefer looking at cash flow?
Well, what's really interesting here is that cash, it's just much harder to manipulate than reported earnings. Accounting rules, while designed to be accurate, they do involve estimates, accruals, things that can sometimes be adjusted.
Might make things look a bit better.
Potentially, yeah. It might present a slightly rosier picture of profitability than the actual cash situation really warrants. Cash flow gives you a more tangible, arguably more accurate measure of the financial strength of the business model. And crucially, its genuine ability to generate the cash needed to sustain and grow the dividend, reinvest, pay down debt, weather storms. It's the real fuel in the tank.
Our sources even provide that data table, looking at companies like Walmart, ExxonMobil, PepsiCo, P&G, AT&T, 3M.
Yeah, from 2006 to 2014.
And looking at their cash flow per share figures over those years, you see this remarkable picture of consistency, even growth for many of them, even through the big financial crisis in 08-09.
Exactly. That table visually reinforces the point. It shows which companies were consistently generating robust cash flow year after year. And that's a powerful indicator of a resilient business, one capable of supporting and increasing its dividend even when reported earnings might wobble due to, say, non-cash charges or accounting quirks.
Okay, so we have the foundational metrics. Now let's talk about the overarching qualities of a strong dividend stock. What characteristics should we really prioritize when we're looking for potential candidates?
The sources strongly advocate starting with companies that have a demonstrated history, a long track record of paying consistent and, just as importantly, rising dividends.
That history matters.
It really does. It's not just a nice to have. It's a powerful signal about management's commitment and the business's underlying health. It significantly lowers the risk of a painful dividend cut down the line.
And it's definitely not just about grabbing the highest current yield you can find, right?
No, absolutely not. That's a common mistake.
Right.
While yield is part of the holy grail, you absolutely must consider the total return potential.
Meaning yield plus.
Plus, the potential for the stock price itself to appreciate over time. If you focus only on the highest yield, you might end up with companies whose high payout is unsustainable. Or maybe their stock price is just tanking because of fundamental business problems. That could easily wipe out any income benefit.
So a key quality then, to assess that sustainability, is the dividend payout ratio.
Right. This ratio tells you how much of a company's profit is being paid out as dividends. You calculate it as the annual dividend amount divided by the consensus earnings per share. Our sources suggest targeting a payout ratio of, say, 65% or less.
65% or less.
And critically, they recommend looking for a company where this ratio has been relatively consistent over the past 10 years. You want to avoid those with wildly fluctuating or rapidly climbing ratios.
And generally, lower is better for the payout ratio.
In most cases, yes. A lower ratio means the company is retaining a larger chunk of its earnings. This provides a cushion, a margin of safety during tough economic times, makes a dividend cut less likely.
And leaves money for growth.
Exactly. It also means the company has more capital available to reinvest back into the business for future growth, or pay down debt, or buy back shares, all things that can ultimately benefit shareholders. If the ratio is consistently too high, say above 65% for years,
Warning sign.
yeah, it signals there's not much room for error if earnings dip. And it might mean they're not reinvesting enough for the future. Now, conversely, an extremely low payout ratio might suggest the company isn't really prioritizing income investors, but that's less common among established dividend payers. You can usually find this ratio pretty easily online or calculate it yourself.
Got it. And when we look at the dividend yield itself, is there a target benchmark? Like, what's a good starting point?
The sources suggest a simple rule of thumb. Look for a dividend yield that is at least 50% greater than the current yield of the S&P 500.
Okay, 50% higher than the S&P 500.
So if the S&P 500 is yielding, say, 1.8%, you'd be targeting stocks yielding 2.7% or more. Another useful benchmark, especially in those low-rate environments like 2015, is the yield on the 10-year U.S. Treasury bond. You generally want your dividend stock yield to be comfortably higher than what you could get from relatively risk-free government debt.
Makes sense.
Yeah.
And the second part of that holy grail, dividend growth, what's the standard we should look for there?
Dividend growth is absolutely essential for maintaining purchasing power over time. The sources recommend looking for companies with a track record of 10 consecutive years of dividend increases.
10 years straight.
And importantly, those increases should average 5% or more annually over that period. At the very minimum, the growth rate really needs to outpace inflation, ideally at least 2% per year, just to ensure your income isn't actually losing value over time.
Are there situations where maybe a stock with slower dividend growth might still be okay or even attractive?
Yes, there can definitely be a trade-off there. Some very large established companies with really high current yields, think AT&T, Verizon, or maybe certain utilities like Consolidated Edison mentioned in the sources, they might have slower dividend growth rates. These can still be attractive for investors who are prioritizing maximum current income right now. But you just need to be aware that the growth component and therefore the inflation protection might be less robust compared to companies with maybe lower starting yields but faster growth. It's just a different profile for a different income need.
What about the company's financial foundation, like the balance sheet, debt?
Oh, absolutely critical. You definitely want to examine the balance sheet. A manageable debt-to-equity ratio is key. Companies loaded up with excessive debt can really struggle to maintain dividend payments, especially if the economy turns down or interest rates rise.
And cash.
Equally important, yeah. Look for companies with plenty of cash on the balance sheet.
Why is a big pile of cash so reassuring for dividend investors?
Well, cash provides immense flexibility and a significant margin of safety. A company with a lot of cash can use it to service its debt, keep investing in the business, even if earnings dip temporarily, maybe repurchase shares.
Which helps shareholders.
Right. And most importantly for income investors, it helps ensure the dividend payment can be maintained even if profits wobble for a quarter or two. Our sources highlight those examples from early 2015 that really show this. P&G with $10 billion in cash, PepsiCo $7 billion, Chevron $14 billion, Intel $15 billion, and J&J with an impressive $33 billion. That kind of cash cushion speaks volumes about a company's stability and its commitment to the dividend.
Beyond just the numbers, what about the actual business the company is in? Does that matter?
The sources definitely advocate for companies with a simple-to-understand business model. Companies selling familiar products or services that people need pretty consistently, almost regardless of the economic climate.
Like consumer staples.
Exactly. They give examples like Kimberly-Clark, Procter & Gamble, Coca-Cola, Johnson & Johnson. Investing in businesses you actually understand that have resilient demand can provide a really solid, understandable foundation for a dividend portfolio. You know how they make money, which just adds a layer of confidence.
Okay, and finally, there's a metric that relates directly to volatility: low beta.
Yes, this is a crucial point, especially when we talk about risk management later on. Beta is basically a measure of a stock's price volatility relative to the overall market, usually the S&P 500, which itself has a beta of 1.0.
So below 1.0 is less volatile.
Correct. A stock with a beta below 1.0 is expected to be less volatile than the market. A beta above 1.0 suggests it's more volatile. The sources suggest targeting stocks with a beta reading under 1.0, ideally 0.60 or even less.
And the benefit of low beta for someone who's really seeking income?
Well, it helps to minimize portfolio volatility. It smooths out the ride, so to speak. For income investors, especially retirees or those getting close, big, sudden drops in portfolio value can be incredibly stressful and disruptive, especially if they might need to sell shares for income when prices are down. A lower beta portfolio aims to still capture some market upside, but crucially, decline significantly less during downturns. And our sources mention studies indicating that low beta stocks have, maybe surprisingly to some, shown a tendency to actually outperform the broader market over the long run, in addition to providing that calmer experience.
Any examples of these low beta dividend stocks?
Yeah, they list some from early 2015 with notably low betas. Colgate-Palmolive at 0.43, General Mills 0.6, Johnson & Johnson 0.48, Coca-Cola 0.47, and AT&T 0.56. So building a portfolio that's tilted towards lower beta names, especially when markets feel expensive, is presented as a really practical way to control risk.
Okay, so we have a really clear picture now of the qualities and metrics of a strong dividend stock. This leads nicely into how some investors categorize these companies into different tiers, right? Moving from the most seasoned dividend growers down to those still building their track record. The sources mention that CCC list framework: champions, contenders, and challengers.
Yes, this categorization, particularly the one highlighted in the Reddit source, is a pretty popular way for investors focused specifically on dividend growth to sort through potential candidates. You'll find other similar lists, too, like achievers, aristocrats, kings, but the CCC lists champions, contenders, challengers, gives a framework based on the number of consecutive years a company has increased its dividend.
Okay, let's start at the top then. Maybe the dividend aristocrats. They sound pretty established.
They are. The definition provided in our sources for dividend aristocrats is quite specific. They're a group of companies within the S&P 500 index that have increased their dividend for 25 or more consecutive years.
Just S&P 500 companies?
For the aristocrats list, yes.
Yeah.
And there's even an ETF, ticker symbol NOBL, that specifically tracks only this exclusive list. It's a very selective group.
And then there are the dividend champions. Are they the same thing, or?
There's definitely significant overlap, but they are slightly different. Dividend champions are defined more broadly as companies that have increased their dividend for at least 25 consecutive years.
So, not just S&P 500.
Exactly. The champion list is broader than the aristocrats list. While all aristocrats are champions, not all champions are aristocrats, because the champion list can include companies outside the S&P 500 or potentially even non-U.S. companies in some lists, although the book excerpt we have focuses on U.S. stocks. That book excerpt from early 2015 highlights a select dividend champions list, and looking at the streak lengths there is, well, it's truly impressive.
Wow. Yeah, looking at that list excerpt is powerful. You see companies like 3M with an astonishing 57 years of consecutive increases. American States Water, 60 years. Coca-Cola, 52 years. J&J, also 52. Procter & Gamble, 58 years. Emerson Electric, 58. Genuine Parts Co., 58 years. I mean, these aren't just short-term trends. They represent multi-decade commitments to returning value through rising dividends.
It's a real testament to the durability of their businesses and, their management's philosophy over a very long time. Okay, so moving down the list from the champions, we have the dividend challengers.
And our sources use the example of VCI properties from that Wide Mode research article as a prime example of a challenger, right?
Yes, VCI properties fits that challenger profile quite well. As of the article's date, April 2025, it was a real estate investment trust, a REIT, that had increased its dividend for 8 consecutive years.
Only 8 years, so that makes it a challenger.
Right. The reason it's a challenger and not a contender or champion is simply because its dividend growth streak is shorter. It was constrained by its relatively recent IPO back in 2018.
But despite that shorter history of dividend increases, it sounds like it's already a pretty substantial company.
Oh, it certainly is. VCI Properties grew incredibly rapidly. It quickly put together a huge portfolio of properties valued at $37 billion, and it was actually added to the S&P 500 faster than any company before it. So while it's technically a challenger based on its dividend streak length compared to those multi-decade growers, it's already a major player in the market by size and index inclusion. The sources note its investment-grade credit ratings, significant liquidity, $3.3 billion in cash, and those trading details from April 2025 priced around $32.97, trading at about 15.7 times its price to funds from operations. It's the key cash flow metric they use for REITs, and it was offering a 5.3% yield. So it's a company on a clear path towards potentially becoming a contender or champion later on if it keeps up that growth streak.
Okay, and then sitting between the challengers and the champions are the dividend contenders.
Right. The Reddit source mentions that Verizon VZ is included on the contender list. Now, the specific criteria for the contender category, like the exact number of years of consecutive dividend increases needed, it isn't quite as precisely defined in our sources as the 25-plus years for champions aristocrats, or that implied sort of under 10 years for challengers based on VCI.
But there's a clue, maybe.
There is. The book source does define dividend growth achievers as companies with 10 or more years of consecutive dividend increases. That's on pages 48-49. So it seems highly probable that the contender category within that CCC framework mentioned on Reddit aligns closely with, or is maybe even the same as, this achiever definition, suggesting maybe 10 to 24 years of dividend growth.
So this whole CCC list, champions, contenders, challengers, it isn't like an index, say the S&P 500, that you can just buy through a single ETF.
That's a really key distinction noted in the Reddit source. The CCC list is a curated list of individual stocks, usually compiled by dedicated investors. There's no specific ETF out there that tracks the entire CCC list as a whole.
So what's the advantage then of having such a list of individual stocks rather than just buying a broad dividend ETF?
Well, the purpose is really to allow investors to be more selective. It's described as identifying the cream of the crop among dividend growth stocks. The idea is that by picking specific companies from these lists that meet your own criteria, maybe looking for a certain combination of current yield and growth, you can potentially build a portfolio with characteristics that might outperform just buying a broad dividend ETF. Those ETFs might hold companies you'd rather avoid for one reason or another.
It lets you customize more.
Exactly. It enables a much more tailored approach to building your income-generating portfolio.
The Reddit commentary had some interesting insights from actually analyzing the CCC list itself. For instance, one user noted that among the top 50 highest-yielding stocks on the list, most had only single-digit percentage dividend growth.
Yeah, that observation highlights a really common trade-off you see in dividend investing. Often, stocks with very high current yields tend to have slower dividend growth rates compared to companies with maybe lower starting yields but faster growth.
So you choose income now or more growth later?
Kind of, yeah. It's something investors need to weigh based on their own income needs and timeline. What's also fascinating from that Reddit source is the observation about the median payout ratio for the entire CCC list in recent history. It had apparently dropped below 40% for the first time back in August 2021 and stayed there.
Below 40%. That seems low.
It's remarkably low by historical standards. It suggests that, as a group, these dividend growth companies have a very healthy margin of safety. They're retaining most of their earnings, which makes their dividends seem quite sustainable and leaves room for future increases.
Okay, now that we know what qualities to look for and how companies get tiered, where do we actually find these dividend-paying stocks? What industries are, common hunting grounds?
Well, the general principle, according to the sources, is definitely to build diversified portfolio. Don't put all your eggs in one basket. Aim for, say, a minimum of 20 stocks spread across various industries, focusing on those with predictable earnings and that history of dividend growth.
Consumer staples seems like an obvious place to start. Things people buy no matter what.
Absolutely. Companies selling everyday necessities, food, drinks, household goods, personal care products, they tend to have pretty stable demand regardless of the economic cycle. This usually leads to more predictable earnings and often that lower beta we talked about.
Examples?
Food products like Hormel or General Mills, personal products like P&G or Colgate-Palmolive, and even tobacco companies like Altria or Philip Morris. The sources specifically highlight tobacco stocks as being remarkably resilient, almost recession-proof, noting their customers tend to tolerate price increases even if volumes decline, making them consistent cash machines.
Utilities are another classic income sector, right? Power, water.
Yes, companies providing essential services like electricity, gas, water, they typically operate as regulated monopolies, which requires massive infrastructure investments, so they often carry significant debt.
And that makes them sensitive to interest rates.
It can, yeah. Because of the debt and the regulated earnings, they often perform best when interest rates are low or falling, as the cost of their debt goes down relative to their income. Consolidated Edison is mentioned as an example with a high yield but typically slower growth. But then you have American States Water, a dividend champion with that incredible 60-year streak, showing there's potential for long-term growth even here.
How about telecommunications? Phones, internet.
Another big one. This industry involves huge infrastructure costs for building and upgrading networks, like 5G now. Plus, it's seen significant deregulation and innovation. Success really requires large-scale and substantial consistent cash flow. The sources suggest sticking with the established large carriers.
Like AT&T and Verizon.
Exactly, they're the prominent U.S. examples. AT&T is noted as a champion with 31 years of increases, offering a high yield but slower growth, and also having that desirable low beta. Foreign holdings like Vodafone are also mentioned as possibilities if you want geographic diversification.
Oil and gas might seem a bit less stable, maybe more cyclical, given the price swings.
It is definitely more cyclical, driven by global supply and demand geopolitical events. It leads to boom and bust cycles. Companies involved in exploration, drilling, production, or the big integrated firms are all sensitive to changes in oil and gas prices.
But they can still be good dividend payers.
Yes, the large integrated firms especially can be significant dividend payers. ExxonMobil is cited as a champion with 32 years of increases, and Chevron with 27 years. While they're sensitive to energy prices, their sheer scale and cash flow can support those long-term dividend commitments.
Our sources also mentioned financials, healthcare, and industrials, often in the context of sector breakdowns in certain dividend ETFs.
Right. These sectors also contain plenty of reliable dividend payers. Examples of champions mentioned include Commerce Bankshares and Financials, 46 years, Johnson & Johnson, 52 years, low beta, and Becton Dickinson, 43 years in healthcare, and 3M, 57 years, though noted as having higher beta, and Dover, 59 years in industrials. The point is, dividend growth opportunities are really spread widely across the economy.
And finally, real estate investment trusts, or REITs. We saw that with VCI properties earlier.
Yeah, REITs are specifically discussed as a potentially high-yield asset class. They invest in and manage income-producing real estate offices, hotels, retail spaces, apartments, warehouses, even things like cell towers now. A key feature is that REITs are required by law to distribute nearly all of their taxable income to shareholders as dividends. That's why the yields can be attractive.
But the sources also pointed out some complexities or potential downsides with REITs compared to regular stocks.
Yes, they did. They can be a bit more challenging to value than typical operating companies. Analysts often use metrics like funds from operations, FFO, and adjusted funds from operations, AFFO, payout ratios rather than PE, because traditional earnings, the EPS, can be distorted by the huge non-cash depreciation expenses that come with owning lots of property.
Okay, so different metrics. What else?
Also, and this is important for tax planning, the income from REITs is typically taxed as ordinary income, not as qualified dividends, which means it might be taxed at a higher rate for many investors. And while they offer diversification into real estate, in big market downturns, REIT prices can sometimes act more like stocks than traditional real estate. They can experience sharp declines too.
Any examples mentioned besides VCI?
Yeah, Federal Realty Investment Trust, which is both a champion and an aristocrat with 47 years of increases. HCP Inc., a champion with 29 years. And the sources also list REIT-focused ETFs like Vanguard REIT, VNQ, for U.S. exposure, and Vanguard Global ex-U.S. Real Estate, VNQI, for international.
Okay. So using all these qualities, metrics, industry insights, how do we actually put together a portfolio? And critically, how do we control risk? The sources seem to define risk quite specifically.
Right. So we can recap the key qualities again. aiming for that payout ratio of 65% or less, a yield comfortably above the S&P 500's. That track record of at least 10 years of dividend growth, the achievers are contenders, manageable debt, healthy cash, and ideally, low beta. But true risk control, according to these sources, it really goes beyond just picking good stocks.
And their definition of risk.
Yeah.
It's different from how academics often talk about it, right? Not just volatility.
Exactly. While volatility, how much a price bounces around, is often used as the measure of risk in finance classes, the sources define risk primarily as the uncertainty of future returns. And, most importantly, the possibility of capital loss, particularly permanent loss.
Permanent loss, that's the real danger.
That's the risk that can truly derail financial plans, especially for income investors who might be forced to sell shares when prices are down just to meet living expenses.
So how do you recognize when that kind of risk, the risk of loss, is elevated in the market overall?
The sources point to specific market conditions. They highlight times when markets are historically overvalued, citing metrics like the cyclically adjusted price-to-earnings ratio, the KP ratio, being significantly above its long-term average. Back in early 2015, when some of this was written, the TPD was around 27, suggesting high valuations.
And what happens then? Investor behavior changes.
Often, yeah. In those environments, investor behavior can become complacent, maybe even greedy. People might pay really high prices without much concern for potential downside because, well, recent returns have been strong. The sources argue that high valuations inherently imply low projected future returns. There's simply less room for prices to rise further from already stretched levels.
And conversely, when is risk lower, according to this view?
Risk, defined as the chance of capital loss and poor future returns, is paradoxically lower when markets are depressed, when prices have fallen significantly, and when fear is widespread among investors.
So when everyone else is scared?
Pretty much. When others are panic selling because they think the market is too risky due to recent drops, that actually creates opportunities for those who recognize value at those lower prices. As Howard Marks, quoted in the sources, puts it, when everyone believes something is risky, their unwillingness to buy usually reduces its price to the point where it's not risky at all.
So the price you pay is key.
It's the single biggest determinant of both the risk you're taking and your potential future return. Buying low reduces your risk of loss and increases your potential upside. It's fundamental.
Okay, so practically speaking then, how do you implement this kind of risk control in your portfolio, especially if you're using dividend stocks?
Well, one practical step mentioned, particularly when the market feels overvalued, is to actively reduce your portfolio's beta.
Lower the volatility.
Exactly. The sources suggest, as an example based on conditions back in early 2015, maybe aiming to reduce the overall portfolio beta by about 30%. The logic is simple. If your portfolio has a beta of, say, 0.60, it's theoretically expected to experience only 60% of the market's moves. So if the S&P 500 drops 10%, your portfolio might only decline 6%. It's about minimizing the damage during bear markets.
And another risk control strategy is simply selling when things get too expensive.
Yes. The sources do present selling stocks when the overall market moves well into historically overvalued territory as a valid risk management tactic. Now, it's acknowledged this is more art than science.
Start to tell the top.
Very hard, and it requires discipline to potentially miss the very last bit of a bull market rally. But the core argument is that by investing defensively, by minimizing those large losses during the inevitable bear markets, you can achieve solid, consistent long-term returns and, crucially, protect the capital base you need to generate income.
Because bear markets are inevitable. History shows us that over and over.
Absolutely. The sources include historical data, like that DJIA table showing past bear market drops, for instance, the devastating negative 2.8% plunge from October 2007 to March 2009. Just acknowledging that these cycles repeat and preparing for them is fundamental to long-term success, especially for income investors relying on that capital.
This is where those powerful quotes from investment legends cited in the sources really hit home. Warren Buffett's rule #1, never lose money, and rule #2, never forget rule number 1.
And his simple but profound advice, be fearful when others are greedy and greedy only when others are fearful. Howard Marks expands on this beautifully with his concept of the investment pendulum, constantly swinging between excessive fear and irrational greed.
Opportunities at the extremes.
Exactly. He notes the greatest opportunities often lie at those extremes, buying from forced sellers during crashes when fear is rampant, and being highly cautious when euphoria leads others to buy aggressively at nosebleed prices. He stresses the need for discipline, conviction in your own view of intrinsic value, and understanding that sometimes doing the conventional thing, like buying when everyone else is euphoric, is actually the riskiest move you can make.
Jeremy Grantham adds that historical perspective too, right? Warning that every great bubble in history has broken.
Yeah, he uses that great analogy of throwing feathers into a hurricane. You can't predict exactly when or where each feather will land, but you know with absolute certainty they will eventually come down. This mix of short-term uncertainty but long-term inevitability of market cycles really informs a prudent approach to risk management, especially when markets get extreme.
It seems like all these insights point to the idea that managing risk isn't about avoiding ups and downs entirely,
No, not at all.
but about understanding when risk, the real risk of loss, is genuinely high, often when prices are high and everyone feels great, and then taking protective action, whether that's reducing beta, raising some cash, or selling things that look overvalued.
Exactly. The counterintuitive wisdom is that the truly risky time is often when everyone feels safest. And the opportunity arises when everyone else is convinced it's just too dangerous to invest.
So given this whole understanding of market cycles, valuations, risk, what are realistic return expectations, especially in different market environments? This seems absolutely critical for income investors planning their lives.
Yeah, this is perhaps one of the toughest points for investors emotionally. Because, as the sources note, our brains often trick us into expecting recent high returns to just keep going forever, especially late in a bull market when valuations are high and confidence is through the roof.
Focusing again on that environment described in our sources from early 2015. What were the conditions then, and what did that imply for future expectations?
Right. In that specific time period, the market was characterized by pretty high stock valuations, that JP ratio around 27, well above average and historically low bond yields. The 10-year Treasury was yielding only around 2%, intermediate bonds even less, maybe closer to 1%.
And the implication of those specific conditions: high stock prices, low bond yields.
The sources argued pretty forcefully that, starting from those levels, projected future returns from traditional assets, stocks, real estate, bonds were likely to be very, very low over the subsequent 5 or more years. It was considered highly unlikely you'd see significant capital appreciation from those price levels.
So what was considered a prudent, realistic expectation for returns back then in that 2015 environment?
The sources basically suggested not expecting much more than the cash flow the portfolio actually generated itself, essentially, the dividends from stocks plus the interest from bonds. In that early 2015 context, this might have translated to realistic annual expectations of maybe 2.5% to 3% before fees or inflation. Significantly higher returns were only considered likely if market prices fell substantially first, during a correction or bear market.
So the expected return changes dramatically depending on your starting point, the valuation environment.
Exactly. It's completely dependent. If you're investing when prices are depressed, say deep in a bear market, your potential future returns from those low prices are much, much higher. The critical takeaway here, and it's a timeless principle even though the context is dated, is to keep your return expectations grounded in the current market environment. Look at current stock valuations, current bond yields. Don't just rely on historical averages achieved over vastly different market conditions.
Why is that so important?
It's crucial for managing your spending and cash flow effectively, especially if you rely on your portfolio for income. And it helps avoid that painful mistake of invading your principal because your returns aren't meeting some unrealistic expectation based on the past.
This leads directly into a really critical topic for many income investors: safe withdrawal strategies, particularly in retirement. It sounds like the traditional rules of thumb might not always apply, especially in certain market environments.
This is probably one of the most important and frankly sobering sections in the source material. Many investors, especially during strong bull markets, they get comfortable withdrawing at relatively high rates, say 6% or more annually. And it seems fine because the portfolio is growing quickly.
But that's dangerous.
It becomes incredibly dangerous, potentially unsustainable when markets decline, or even if they just flatten out, especially if you started retirement when valuations were high and yields were low.
The widely cited 4% rule for retirement withdrawals is a common guideline people hear. Where did that come from?
The sources trace its origins back to studies done mainly in the 1990s, notably by a researcher named Bill Bengen. These studies looked at historical market data and tried to find a withdrawal rate that would allow a portfolio to last for 30 years, with withdrawals adjusted annually for inflation. They based it on high historical average returns, typically assuming around 10% a year for stocks and 5.5% for bonds. Under those assumptions, the 4% rule had a high historical success rate.
But the sources argue that the 4% rule wasn't necessarily safe anymore, at least not in the context of early 2015.
Precisely. The core problem they identified is that the fundamental assumptions behind those 1990 studies, those really high historical average returns, were simply seen as too optimistic when applied to a market environment like early 2015, which again had those low bond yields around 2% and high stock valuations, with KPE near 27. The projected returns starting from that point were likely to fall far short of the historical averages used in the original 4% rule studies.
So what did more current, more realistic studies cited in the sources suggest about withdrawal rates in that kind of environment?
Well, the sources refer to studies from 2013 by Blanchett, Fink, and Faux, and also Morningstar Research. These modeled withdrawal success rates based on the starting market conditions specifically, bond yields, and equity valuations like CPE. And these studies painted a much, much tougher picture for the 4% rule.
How much tougher?
The data presented is pretty stark. For a 30-year retirement portfolio allocated 60% to equities, facing a bond yield of only 2% and a high KPE of 25, the chance of that portfolio lasting 30 years with a 4% initial withdrawal rate adjusted annually for inflation dropped to just 48.5%.
Wow, less than a 50-50 chance.
Less than a coin flip. That's a dramatic difference from the high historical success rates often quoted for the 4% rule.
So what kind of withdrawal rates did those studies suggest for a higher probability of success in that low-yield, high-valuation environment?
To get a high probability of success, say, a 95% chance for that same 30-year retirement portfolio, 60% equity, 2% bond yield, CP25, the study suggested the appropriate withdrawal rate needed to be drastically lower, perhaps as low as around 2% annually.
Only 2%?
Yeah. It implies that for long retirements starting in challenging market environments, like the one described in 2015, the traditional safe withdrawal rate might need to be nearly cut in half compared to the 4% rule derived from much rosier historical averages.
That requires a huge adjustment in lifestyle or expectations for a lot of retirees. What were the specific suggestions then for implementing safer withdrawal strategies, especially for people with a long life expectancy, say more than 50 years?
Several suggestions were offered. One was to maybe reconsider increasing the withdrawal amount automatically every year for inflation. Instead, perhaps stick to withdrawing a fixed percentage of the current portfolio value each year. So if the portfolio drops, your withdrawal drops too.
Okay, that's one way.
Another key suggestion was to be flexible and willing to reduce the withdrawal rate during market corrections or bear markets. For example, if your portfolio value drops by 10% or more, consider cutting back the withdrawal rate to 3%, maybe even less, temporarily. This preserves capital and gives the portfolio a much better chance to recover when the market eventually rebounds.
That sounds incredibly difficult, though, for retirees who often have fixed expenses. Cutting spending like that.
It's acknowledged, yeah. Reducing spending during tough times is very challenging, psychologically and practically. So a more conservative approach suggested, especially if you have a long retirement horizon over 15 years, or you're starting retirement in a persistent, low-yield, high-valuation environment, is to simply start with a much lower initial withdrawal rate from day one, maybe 2.5% or even less annually.
Start lower to be safer.
That's the logic. A lower withdrawal rate puts far less strain on the portfolio, giving it a much greater chance of surviving bad market conditions early in retirement, which can be devastating. Then, if interest rates rise or stock valuations become more favorable later on, leading to higher projected returns, you could potentially increase your withdrawal rate down the road.
So the absolute critical point here seems to be that you must adjust your withdrawal strategy and rate based on the current market environment, the actual prevailing bond yields and equity valuations, rather than just blindly relying on historical rules based on average returns from potentially very different times.
Precisely. The research really demonstrates how sensitive retirement portfolio longevity is to those starting conditions. Ignoring the reality of current low yields and high valuations when they exist, and just applying historical rule like 4% significantly increases the risk of running out of money over a long retirement. It's all about being adaptive and realistic based on the financial landscape you're actually facing.
This has truly been a deep dive. We've covered everything from the fundamental appeal of dividend investing, those crucial metrics to evaluate companies.
Yeah, the payout ratio, cash flow, beta.
Through the categorization of dividend growth stocks into champions, contenders, and challengers, exploring potential industries.
And critically, examining how to control risk based on market valuations and adjust withdrawal strategies for retirement based on the current financial environment, not just those historical averages.
Let's quickly summarize the key takeaways then. We've seen the power of dividend investing as a strategy for both income generation and wealth growth. built on that crucial combo of current yield and dividend growth.
Mm-hmm. And we highlighted the importance of looking beyond just the headline yield to really assess a company's health and sustainability using metrics like the dividend payout ratio, cash flow per share, and maybe that low beta for stability.
Understanding those different tiers, too, from the incredible long-term commitment shown by Dividend Champions with their multi-decade growth streaks to the sort of up-and-coming potential of challengers, it gives you a framework for identifying different types of dividend growth opportunities.
Yeah, and we touched on diversifying across industries and prioritizing companies with resilient, understandable businesses and strong balance sheets, plenty of cash.
And perhaps the most profound lessons drawn from these sources relate to the reality of market cycles and that non-negotiable need for risk control. Recognizing that true risk is about potential capital loss, often highest when market prices are high and valuations are stretched. That seems paramount.
Absolutely. And that understanding has to then inform our investment decisions and, critically, our withdrawal strategies, prompting us to adjust our expectations and spending based on current market conditions rather than relying on outdated historical norms that might not apply anymore.
It really underscores that success isn't just about picking the right stocks, is it? It's about managing your portfolio wisely through every phase of the market cycle.
Which leaves us with a powerful thought to consider, I think.
Yeah.
One that echoes that counterintuitive wisdom from our sources, especially Howard Marks. When everyone believes an investment is risky, their unwillingness to buy usually reduces its price to the point where it's not risky at all.
Conversely, when others are recklessly confident and buying aggressively, we should be highly cautious. When others are frightened into inaction or panic selling, we should become aggressive. Wow.
Yeah.
That requires immense discipline, though, to act contrary to the herd like that.
It absolutely does. Ultimately, maybe the real income tier isn't solely determined by how much capital you have, but by the wisdom and discipline with which you manage and protect the cash flow that capital generates.
So it's about navigating the market's emotional swings.
I think so. Navigating that pendulum with a clear-eyed view of value and a flexible approach to both risk and withdrawals, that's what helps ensure your financial comfort can actually endure through all kinds of market conditions.
Well, thank you for joining us for this deep dive into U.S. dividend stocks and these related income tiers to champions, contenders, and challengers. We really hope the insights from these sources provide some valuable perspective for your own financial journey.